The next great market sell-off may not begin on the trading floors of Wall Street. It might not be triggered by a central bank announcement or a sudden credit crunch. Instead, the first tremor could be felt far from the financial centers, in the quiet, methodical world of customs inspections and shipping manifests. The next sell-off may not start on Wall Street. It may start at customs. This is where the new economic conflict of 2025 is taking shape. It's a battle fought not with armies, but with executive orders, tariff codes, and shipping containers. A silent war is unfolding at our ports and borders, one that threatens to send a shockwave through the entire global economy. Imagine a simple cardboard box, one of millions that cross borders every single day. For years, many of these packages, valued under $800, entered the United States duty-free under a rule known as de minimis. But in 2025, that has changed. A sudden policy shift has closed this loophole for many shipments, effectively creating a new package tax. Now that box is flagged, inspected, and slapped, with an unexpected bill for duties and fees. It's a small change on a small box, but when multiplied by millions, it becomes a seismic event. How does a tax levied at the border, a tariff, ripple outward to touch every corner of our lives? It begins with the importer, the business that brought that product into the country. They are the first to pay the price. But that cost doesn't just disappear. It gets passed along from the wholesaler to the small business owner, to the online marketplace seller, to the consumer at the checkout counter. The price you pay for electronics, for furniture, for the shoes on your feet begins to climb. It's a slow, creeping inflation that eats away at household budgets and corporate profits alike. The journey from a customs declaration to a stock market downturn is shorter and more direct than many realize. When companies see their costs rise, their profit margins get squeezed. Lower margins mean lower earnings per share, a critical metric for investors. If earnings begin to falter, the very foundation of stock valuations begins to look shaky. What breaks first? Profits, multiples, or confidence? The administration has embraced a strategy of imposing tariffs by executive order, creating a constant state of policy uncertainty. Businesses, which thrive on predictability, now find themselves navigating a landscape where the rules can change with the stroke of a pen. This isn't a single, well-defined trade war. New, higher duties have been placed on a wide array of goods from economic powerhouses like India. The most widespread impact comes from the changes to the de minimis rule, which strikes directly at the heart of the modern e-commerce economy. The government has introduced friction and cost into a system designed for speed and efficiency. Shipments now face delays, new brokerage fees, and unexpected duties, threatening the business models of many online retailers. As costs rise, a global reshuffling is underway. This is known as trade diversion. Mexico is emerging as a clear winner. Vietnam is gaining in apparel and electronics. Turkey and Poland are becoming attractive new sources. This new era is not going unchallenged. The rapid-fire use of executive orders has sparked fierce legal battles. Rulings from courts can create binary outcomes, leading to massive swings in corporate outlooks. To understand the risks of 2025, we must look back at the ghosts of trade wars past. The most infamous is the Tariff Act of 1930, Smoot-Hawley. Born from a desire to protect American farmers and industries, the act raised U.S. tariffs to record levels. America's trading partners responded with anger and retaliation. This is the first and most crucial lesson of trade history. Protectionism is contagious. Global trade contracted, deepening the Great Depression and spreading economic misery worldwide. In August 1971, President Richard Nixon announced a temporary 10% surcharge on virtually all imports. In 2002, President George W. Bush imposed temporary safeguard tariffs of up to 30% on imported steel. The move was challenged at the WTO, and the EU threatened retaliation, forcing the administration to withdraw the tariffs. Fast forward to the 2018 to 2019 United States-China trade war, the most direct precursor to the current situation. This period conditioned investors to trade on policy headlines, creating a volatile link between Washington, Beijing, and Wall Street. From Geneva, WTO Director General Ngozi Okonjo-Iweala issued stark warnings about an unprecedented disruption to global trade norms. IMF Managing Director Kristalina Georgieva called trade fragmentation a primary risk, fueling inflation and stifling growth. Fed Chair Jerome Powell acknowledged the inflationary pressure, but remained cautious, insisting the Fed would stay data-dependent. In Europe, Ursula von der Leyen pushed back, speaking of countermeasures while calling for negotiation. Mexico's President Claudia Sheinbaum took a pragmatic stance, aiming to benefit from nearshoring while avoiding direct conflict. India's Prime Minister Narendra Modi vowed to protect India's interests, balancing diplomacy with a defiant domestic message. And Donald Trump defended the strategy he pioneered, arguing its overdue leverage to rebalance trade and onshore jobs. There are two possible scenarios. Let me explain. In the first scenario, the tariffs stick. This would mean persistent margin pressure, slower investment, and enduring price bumps until supply chains fully adapt. In the second scenario, a partial rollback occurs due to political or legal pressure. We'd see selective relief and easing prices, but trust would take time to heal. For consumers, check the origin, budget for duties, and prefer vendors from non-tariffed countries. For small business importers, audit your HS codes, rebuild cost models, and consult experts like customs brokers and trade attorneys. What to watch? Court milestones, CPI goods inflation, PMIs, and retaliation talks from the EU and India. In the end, we return to where we began, the customs line. This once overlooked intersection has become the new front line in a global economic conflict. The core lesson is that in a deeply interconnected world, a tariff levied at the port of Long Beach creates ripples that reach a factory in Bengaluru, a boardroom in Brussels, and ultimately, the 401k statement of an American worker. The great question of 2025 is whether these ripples will calm or whether they will converge into a tidal wave. The next sell-off may not start on Wall Street, but it could very well end there.